Welcome back to The Explainer. Today, we're doing something a little different. We are literally mapping out the minefield of newbie investor traps. Our goal? To save you from some incredibly costly mistakes. Because look, investing is a fantastic, absolutely critical tool for building lasting wealth, but it's also a landscape completely filled with hidden pitfalls. So we're going to shine a huge spotlight on the exact errors that trip up almost every single beginner, so you can walk confidently straight past them.
You know, someone once said there's an ignorance tax we must all pay when doing something new. And man, that hits the nail on the head, doesn't it? Everyone enters the market with a ton of enthusiasm. But without the proper knowledge, well, we end up paying this inevitable ignorance tax. It drains your account, it's incredibly demoralizing, and it severely hinders your long-term success. But hey, the good news is we can bypass this tax entirely.
Okay, let's dive right into our agenda and learn exactly how to disarm these hazards step by step. We're looking at the ignorance tax, hype and diversification, the perfect timing myth, loss aversion, fees and compounding, and finally, emotional resilience. Let's get into it.
Right. Section 1. Paying the ignorance tax. We really have to start by examining that dangerous combo of high enthusiasm and minimal knowledge.
So when you're super excited but completely inexperienced, you actually become the perfect target. Driven by all that hype, beginners get lured in by these social media snake oil salesmen, pushing, frankly, dog shit investment courses. You end up buying into these wild promises and repeating the exact same demoralizing errors that millions of other beginners make. Without a solid baseline of knowledge, you're pretty much just flying blind into a storm.
Section 2. Hype, research, and diversification. The first major trap here is jumping headfirst into hyped-up assets. Like buying a stock just because it has AI in the name without ever bothering to check the company's actual revenue.
And what's really fascinating about this is that it's driven by something called overconfidence bias. It's this psychological trap where when you know absolutely nothing about a topic, you don't even possess the knowledge to understand why you might be wrong. You simply don't know what you don't know. So naturally, you just assume you know a whole lot more than you actually do.
But here's the tricky part, right? Even if you do your research, unforeseen things happen all the time. Just look at the source material for today. The author carefully researched and bought into a rock-solid Australian ticketing company designed for small events. It looked like the ultimate sure thing.
Now, this starkly contrasts the expectation of a flawless business plan with the reality of an absolute unforeseeable disaster. Because exactly 3 months after they made that investment, the COVID pandemic hit. The company itself was incredibly solid, but it failed due to a massive global event that literally no one could have ever predicted.
So, how on earth do you survive the totally unexpected? Well, the author only survived that Australian ticketing collapse because their investment was part of a much larger, highly diversified portfolio. Beginners, especially those with low capital, tend to completely skip diversification. If you don't have a lot of money to spread around, you absolutely need to consider using ETFs rather than betting the whole shebang on one single asset.
Moving on to Section 3, the perfect timing myth. This is a trap that keeps countless would-be investors completely frozen in their tracks.
I mean, we hear it all the time, right? Buy low, sell high. It's the golden rule. But because of this mantra, beginners just sit on the sidelines, totally paralyzed by media noise, endlessly wondering if right now is the exact perfect time to jump in. The problem, and honestly the harsh reality of investing, is that absolutely no one has a crystal ball. There is no magic indicator and no one out there who can tell you exactly when the market has hit absolute rock bottom. Focusing on perfectly timing the market, it's a total fool's errand. Which leads us straight into the incredibly dangerous trap of trying to catch a falling knife. Beginners actually think they can outsmart the markets and grab a plunging stock at the very bottom. Instead of playing that dangerous game, successful investors focus on time in the market. They use cost averaging to smooth out their entry points over time, relying on long-term data rather than short-term guesswork.
All right, Section 4. Loss aversion and panic selling. Let's see how this builds into devastating emotional errors when the market actually dips.
Have you ever wondered why seeing red numbers on a screen makes your heart race? Well, that's loss aversion bias in action. Psychologically speaking, losses feel roughly twice as painful as gains feel good. Losing $500 hurts way worse than gaining $500 feels good. And for a beginner, that intense emotional pain triggers immediate panic selling.
Let's look at exactly how this plays out in the real world. A beginner buys a stock at $42, but they have absolutely no plan. When the stock inevitably tumbles down to $38, they panic and sell. Now, an expert, on the other hand, sets a firm $45 exit plan before they ever place the investment.
So, the expert stays perfectly calm through that exact same market dip because they have a plan based on hard information. The beginner is just flying blind and reacting to pure emotion. Always remember this vital rule. Information kills panic.
Section 5, Hidden Fees and Lost Compounding. Because that beginner panic, it triggers a whole new set of quiet, account-draining problems.
Constantly jumping in and out of assets as you try to fix your mistakes creates this slow, hidden bleed on your account. First off, overtrading racks up hidden fees that totally eat whatever small profits you make. But worse, it completely destroys the power of compounding. By impatiently chasing quick returns, you completely miss out on exponential growth and reinvested dividends.
To put that into perspective, think about a simple starting sum of $1,000. That $1,000 can grow surprisingly fast if you just hold long-term, receive your dividends, and reinvest them. But if you're constantly buying and selling out of impatience, you're basically hitting the reset button on your progress over and over again. Your money just isn't compounding.
Finally, Section 6, Building Your Emotional Resilience. Ultimately, the journey of investing is just as much about mental discipline as it is about knowing the right financial jargon.
You can literally stop paying the ignorance tax right now by building your foundation on these 3 pillars. 1. Education. Do the actual research. 2. Clear planning. Know your exit strategy before you buy. And 3. Emotional resilience. Understanding these pitfalls so you stay completely calm when the market fluctuates. These are the absolute foundations for sustainable success.
Oh, and just a quick reminder before we wrap up, this explainer provides general information only. It doesn't consider your personal objectives or financial situation, so please always seek professional advice before making your own real-world financial decisions. Well, we've mapped out the minefield and shown you the hidden traps. You now have the knowledge that most beginners lack, so the only question left to answer is, you know the traps. What is your plan? Are you going to let your emotions drive your wealth, or are you ready to use these tools to build a resilient financial future? Think on that as you map out your next move.